phones in silent. We've got 1 minute to go.
30 seconds.
Good day. Over the past year, rising vaccination rates have sustained confidence in the global economic recovery despite the rapid spread of the Omicron virus in recent months. Looking ahead to this year, we expect global growth to be slower as the rebound from the pandemic fades. Growth in emerging market and developing economies will continue to lag that in advanced economies due to a slower pace of vaccinations and other headwinds. South Africa's economy rebounded strongly from the pandemic in 2021, but going forward, the growth rate will, like global growth, slow and remain subject to various risks. The International Monetary Fund's forecast for global gross domestic product is unchanged at 5.9% in 2021. Global growth is expected to slow to 4.4% in 2022. The SARB's forecast for global growth in 2021 sits at 6.2% and is unchanged for 2022 and 2023 at 4.4% and 3.3% respectively. GDP growth in our trading partners in 2024 is forecast to be 2.7%. Global economic conditions are less supportive of emerging and developing economies now than they were for most of this past year. Although policy settings in advanced economies remain accommodative, higher global inflation is likely to accelerate normalization of interest rates and balance sheet reduction by major central banks. It is less certain now how far the normalization process will go and the exact timing. And this uncertainty continues to cause financial market turmoil and capital flow volatility. Risk aversion in financial markets has increased. Economies that failed to take advantage of better global conditions or to reduce large macroeconomic imbalances remain vulnerable. Last year saw the ongoing recovery of the South African economy from the pandemic, but also the damage caused by the July unrest, cyber attacks, and strikes. Those factors led to a downward revision to the growth forecast for the year as a whole, from the 5.2% forecast in November to 4.8%. This year and next, economic growth will remain well above the low rate of potential growth. GDP is expected to grow by 1.7% in 2022. The deceleration in growth from 2021 to 2022 is primarily a result of the fading rebound from the pandemic, alongside a climb down from high export prices. GDP growth is forecast to be 1.8% in 2023 and 2% in 2024. With lower export prices, the economy's future demand growth will depend more on investment and household spending. Sustained low borrowing costs and faster economic growth have strengthened private sector investment somewhat, despite ongoing constraints from load shedding and policy uncertainty. Household spending remains supportive as a result of good growth in disposable income, rising asset prices, and more credit demand. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced. With the downward revision to GDP growth for 2021, the output gap is more negative over the forecast period compared to the November meeting. However, as the economy is forecast to grow faster than potential, the output gap closes steadily through to 2024. While important commodity export prices such as for coal, iron ore, platinum, and rhodium generally decreased in the latter half of 2021, in recent weeks, some prices and export values have been more buoyant. As a result, the current account surplus of the past year is expected to decline at a slower pace than at the time of the November meeting. The current account deficit in 2023 and 2024 is, at this stage, forecast to be smaller than previously expected. Although fiscal risk has eased, financing conditions remain volatile and the yield curve for rand-denominated bonds remains steep. 10-year bond yields remain at about 9.4%. For most of 2021, strong commodity export prices and generally favorable global financial and economic conditions have strengthened the currency above its long-run equilibrium level. In recent months, global and domestic factors contributed to a weaker rand exchange rate, and the rand now sits somewhat below its equilibrium level. The implied starting point for the rand forecast is 15 rand 60 cents to the US dollar, compared with 15 rand 10 cents at the time of the previous meeting. Over the past year and into this year, global supply shortages and strong demand have caused a wide range of prices to accelerate, including raw materials, intermediate inputs, and food. Some of these price increases have passed through to consumer prices in major economies. Our estimate for inflation in the G3 was revised higher to 3.1% in 2021 and 2022, and is revised slightly lower to 1.7% in 2023. For 2024, G3 inflation of 1.6% is forecast, unchanged from the previous meeting. Oil prices are revised up for this year, and fuel price inflation is higher at 13.7%. Local electricity price inflation for 2021 was 10.2%, while the forecast for 2022 is revised up to 14.5%. For 2023 and 2024, electricity price inflation of 12.4% and 10% is expected, unchanged from the previous meeting. Headline inflation in 2021 came out at 4.5%. The bank's forecast of headline inflation for this year is revised higher to 4.9%. Headline inflation is expected to be 4.5% in 2023 and 2024. Core inflation was 3.1% in 2021 and is forecast to rise to 3.8% in 2022. With the economy expanding faster than potential over the forecast period, core inflation is projected to rise to 4.5% despite a still low rate of services price inflation and unit labor costs. Core inflation forecasts for 2023 and 2024 are unchanged at 4.4% and 4.5% respectively. The risks to the inflation outlook are assessed to the upside. Global producer price and food price inflation continued to surprise higher in recent months and could do so again. Oil prices increased strongly through 2021 and are up sharply year to date. Current oil prices sit well above forecasted levels for this year. Electricity and other administered prices continue to present short and medium-term risks. Given the moderate medium and long-term inflation projections set out above, higher domestic import tariffs, stronger services inflation, and higher wage demands present additional upside risks to the inflation forecast. A particular risk arises from the possibility of a faster normalization of global policy rates than is currently built into the forecast, which assumes some rate hikes to begin around June of 2022. Added to this is the risk that quantitative tightening will occur more quickly than previously expected, leading to stronger capital flow reversals from riskier assets such as emerging market debt. Average surveyed expectations of future inflation have increased to 4.8% for 2022. Market-based surveyed expectations for inflation have also eased to 4.8%. In the near term, headline inflation has increased well above the midpoint of the inflation target band and returns close to the midpoint in the fourth quarter of 2022. Some risks to the inflation outlook, like food and fuel, have been realized, and other risks such as currency volatility and capital flow reversals have become more pronounced. Against this backdrop, the MPC decided to increase the repurchase rate by 25 basis points to 4% per year with effect from the 28th of January 2022. 4 members of the committee preferred an increase and 1 member preferred an unchanged stance. The implied policy rate path of the quarterly projection model indicates gradual normalization in the first quarter of 2022 and into 2023 and 2024, given the inflation forecast. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Given the expected trajectory for headline inflation and upside risks, the committee believes a gradual rise in the repo rate will be sufficient to keep inflation expectations well anchored and moderate the future path of interest rates. However, economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects. Current repurchase rate levels reflect an accommodative policy stance through the forecast period, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. Better anchored expectations of future inflation should keep interest rates lower for longer and can be realized by achieving a prudent debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. This concludes the MPC statement, and I understand that all of the good gentlemen and women of the media are on the line, and Zianda, if we could invite them to field their questions, and then we will distribute them as appropriate to the MPC members.
Thank you, Governor. There's no questions yet. If we could please give the media a second.
Any progress?
Yes, Governor, I've got a number of questions from Pranisha from Bloomberg. Did the MPC discuss raising the rate by more than 25 basis points? If so, what was the quantum and what informed that decision, and why did you ultimately opt not to do so? Please quantify the impact that a single or each 25 basis point hike will have on both headline inflation and economic growth. Do you still see inflation as transitionary, or is it becoming endemic? Barring upward moves by the Sarb and considering high administered and unregulated prices, including energy costs, what do we need to address this? Your core inflation forecasts continue to suggest that demand is weak. What's your assessment of how the economy is doing? Have we fully recovered from COVID-19? Does the weakness predate the pandemic? And then what's driving the MPC's expectation that the economy will grow above potential? And there's two more questions from Bloomberg. It's Pranisha. It's still Pranisha from Bloomberg. And the fifth question, what's driving the MPC's expectation that the economy will grow above potential? Did the Fed's plans announced last night change the thinking amongst the MPC members on the pace of removing policy accommodation? The last question, are you satisfied that today's move and the rate path suggested by, she didn't manage to complete that one. So those are all her questions for now.
Okay, so that we can give her the breather. Can we take one more question from somebody?
Okay, let me have a look. Okay, she managed to submit it, Governor. Are you satisfied that today...
Who is that?
Pranisha.
No, I said from somebody.
That her last question was incomplete.
Okay, what was incomplete saying?
Okay. Are you satisfied that today's move and the rate path suggested by the QPM is enough to make the real rate more attractive and act as a buffer of sorts against a more hawkish Fed?
Okay.
Those are all the questions for now, Governor.
So it's only Pranisha?
For now.
Yes, yes.
Yes.
Okay, thank you very much, Pranisha. A simple answer to your first question was that the discussion was whether we hike by 25 basis points or we stay. There was no discussion about whether we do more than that. Chris Logal, you're going to answer the question about the quantification of the impact of the 25 basis points on both growth and inflation. Just prepare yourself for that. Is inflation transitory or permanent? It depends. There are elements that are transitory and there are elements that could as well be permanent. Whether transitory or not, what we are focused on is what are the second round effects of those changes in the inflation rates or those prices of particular commodities. Without a doubt, if we feel that there is potential, underline that, potential for second round effects to kick in and thus lead to faster inflation, we are bound to act. The environment is uncertain, which is why we are taking these measured steps to deal with the emerging risks to inflation. You asked, core inflation forecast seems to suggest that demand is weak. I'm not sure what weak means in this instance. It's definitely stronger than it was during the lockdown. What we use core for is to measure whether there are generalized increases in prices if we strip out the volatile elements of the price formation process. And our preferred measure of core is headline excluding fuel, electricity, and food prices. And based on that measure, we can see that there are pressures that are building up. What proportion of those pressures are demand? What proportions of them are supply? Well, I know people get into these things. The point here is, if we say there are supply constraints and the supply constraints are not dealt with, and demand remains unfulfilled, we are going to have prices rising. So it becomes irrelevant as to whether that there are the supply constraints. It's a question of how long those supply constraints last. And in your own words, you said, are they transitory or are they permanent? As I said, the jury is out. Some of them might be transitory, some of them might be permanent. What is in no doubt is that COVID did lead to significant shocks or disruptions in supply chains, both globally and domestically. And as demand recovers, it is not recovering into the previous supply, it is recovering into a constrained supply or a supply that is significantly disrupted and thus leading to rising prices. What our expectations? What drives our expectations that growth will be above potential? No, it's not a question of just expectations. We are forecasting that growth will be 1.8% this year, and that it would rise to 2% by 2024. And we have got potential at 0.8. So our projection of growth is already higher than potential, and as such, there isn't a question of expectation. It's a given thing. That is our forecast for growth. And I think the question maybe you wanted to ask is what would be driving growth in this process. And as we had spelled out, we had strong support from the global economy. That global support is actually significantly slowed down as the whole of the world is also slowing down getting into this year. But there is support that is what we are seeing coming from household consumption expenditure, and we are seeing some recovery in investment. So there are a number of factors that are coming through. Are we satisfied that the repo rate path that is suggested in the QPM will take care of the real repo rate? Well, our satisfaction does not have to come from the QPM. Our satisfaction must come from the decisions we make. The QPM does not make decisions. The QPM is an input into the decision-making process of the MPC. It is just but one input. We can't outsource our decisions to a model. That is why you have got a committee. We deliberate, and based on our deliberations, we take what we believe is an appropriate decision. And the decisions that we have taken from November and now, we believe are decisions that are measured, will take care of the emerging inflation risks, whilst at the same time continuing to provide support to households and firms, as you see reflected in the monetary policy stance going forward, that it remains accommodative. Chris, before I come to you, is there anybody wants to add anything to the answers I provided? No? Chris?
Thanks. Look, I can't quantify each and every hike. The forecast that we have is released. What is safe to say is that any interest rate hike has the effect of slowing demand growth, and that all of the hikes that are in the QPM forecast trajectory are reflected in the GDP and inflation numbers that we put out. It is, I think, important to recognize, though, that while demand growth is slowing, the metaphor here isn't hitting the brakes. The metaphor here is really about taking our foot slightly off the gas pedal. Real rates are still negative. The output gap is closing through our forecast period. That is pushing up core inflation. We see stronger household consumption spending. We see a bit more of a pickup in investment. And it's quite important because that impact of core rising, because we've flagged very high current headline inflation risk. And if you add core to that, you're going to end up in a situation where long-term inflation starts to rise. As long-term inflation rises, long-term yield costs rise. And that, in turn, hits long-term investment, public sector borrowing costs. And so there's a bit of a trade-off here between the damage that high inflation will do to long-term interest rates and growth relative to this very minor slowing in demand growth that we're seeing from these repo rate adjustments. Thank you.
Thank you. We've got a question from Hilary Joffe from Business Times. Governor, are you still keen to see the inflation target lowered from the current 3 to 6%, perhaps to 3? Her second question, could you expand on your comment about the risks that monetary policy tightening will occur more quickly than expected? What exactly are you concerned about? Questions from Alex Winning at Reuters. Could you say whether you expect headline inflation to breach 6% in the coming months? How worrying is a temporary rise above 6% in terms of inflation expectations? Would a breach above 6% make further rate hikes more likely? We've got a question from Lucania at Business Day. Can the governor or another MPC member say what the argument for staying unchanged was, given that there was such a consensus on increasing the rates? Those are all the questions for now. Thank you, Governor.
Okay. Am I still keen to see the inflation target lower? It's not just a question of keenness. It's a question of what is in the best interest of the South African economy. There is no virtue in higher inflation. As we had stated before, our inflation target is wider than the inflation target of other inflation targeters. It is also higher than that of our peers and competing countries, which means that we are less competitive than those countries are. Like I had said, there is a process that is taking place. There is a macroeconomic review that is led by the National Treasury. We will take cue from that, but suffice to say that lower inflation is in the better interest of the South African economy. It would lead to better competitiveness, and is actually for the benefit of those members of our society who live on fixed income and cannot bargain to get their incomes rise faster than inflation, or protect their incomes against rising inflation. Risks about faster monetary tightening, I we were very clear. We were talking about the risks from the advanced economies tightening monetary policy faster. And I think that this links to the question that was raised earlier as to whether we took account of what the Fed was saying yesterday. The point of the matter here is that inflation in the advanced economy is running ahead of targets. It's at historic highs, and that those central banks have started to indicate that they would be doing something about it. That they would be doing something about it is beyond the question. It's going to happen. The question is that of timing. And the risks that we see is that they might actually do that earlier than we had said. Our forecast says that is based on tightening in the advanced economies taking place around June of this year. If it takes place earlier, it actually obviously changes what we are faced with, and that is what we were talking about. Alex raised the question about breaching. If the inflation breaches above 6%, would we then be acting more aggressively? Well, by that time, it might be too late. There is nothing we can do about yesterday's inflation or today's inflation. We can do something about tomorrow's inflation. And our own forecasts do not suggest that inflation would breach the 6% upper limit of the inflation targeting band. And it is not in any of our baseline scenario. Of course, if it was to happen, it might fit into future inflation expectations. But if anything, the point that we started acting in November and we are acting now in this meeting says to you that we are doing something about future inflation. There is nothing that we can do about November's inflation or December's inflation or even January's inflation, because the monetary policy horizon runs over a 12 to 18 months period. Arguments for staying the same rather than increasing because there was a consensus. We do not take decisions based on what the markets expect. We take decisions on the analysis that we have made and our own take about the inflation outlook. There was no doubt, as we have said in the previous statement and we are saying now, about the pace of the normalization that it will take place. The only debate was about timing of increases rather than whether there should be an increase or not.
Thank you, Governor. I've got 3 more questions. One question is from Vuyani Ndaba at Bloomberg. How significant are global supply side constraints weighing on South African inflation? Is there a chance, if they dissipate, that South African inflation is still in disinflation?
Rashad, that's yours.
Another question from Lukanya at Business Day. He's referring to inflation targeting. Previously, the governor suggested a lower target. Does the inflation outlook rule that out, given it might imply even tighter policy? Then we've got a question from Pranisha. Do you agree with the QPM suggesting a lower rate path when inflation and growth are now seen to be higher than at previous meetings? And please clarify how many interest rate hikes through 2024 the QPM is now suggesting. I apologize, Vuyani Ndaba is from Reuters.
Okay.
Thank you.
Rashad, let's start with you. And who wants to take the question about the lower target and the policy rate? It's becoming my issue all the time. Between Fundi and Kuben, one of you, I'm volunteering one of you. Chris, can you take the QPM rate path? Rashad?
Thank you very much, Governor. So it's obvious that supply-side constraints are universal. It's most prominent in the U.S., accounts a lot for inflationary pressures in the U.S. In the South African case, I think that there's some evidence that global supply-side constraints are prominent in motor vehicles. There's some evidence, if you look at the producer price index, there's some elements where some of the inputs that firms are using, there's supply-side constraints. One doesn't see this directly in the CPI numbers. So that's the one aspect, but if you look at the CPI as a whole, there are other areas which are not necessarily of a supply-side constraint related, and that is, the services part. So rentals are picking up a bit, the whole variety of other services that are recovering from last year. So in the scheme of things, supply-side constraints are there, but the constraint is perhaps less binding than, say, like in a country like the US, where the economy is really overheating with a very overheated labor market. Thank you.
You go, Kuben.
Sure. Thanks. Let me, I guess, repeat a point that the governor made, that the inflation target is the subject of a review by the National Treasury. This does not influence our monetary policy making today. It doesn't influence the QPM, and it doesn't influence our forecast. So it's an entirely hypothetical question of whether today's forecast rules out a lower target or not. My advice is let the Treasury's macro review complete its process. Let there be the public discussion that is needed on the issue. And once government and the Sarb take a decision on the matter, then we can begin to factor those things in. It would be intellectually dishonest for us today to target two targets, right? We have a target from government, and that's a target that we target, and that's the target that we set. We have been consistent that we think that lower inflation would be good for the South African economy, but we don't set the inflation target in isolation. So let's let that process complete before prejudging it. Thanks.
Chris, QPM.
Yes, that's 275 basis points to the end of the forecast period at 25 basis points a pop. That's 11 rate hikes.
Well, it was more than that. It said that the QPM is saying is projecting lower, and how would that take care of that? And that's because I think that we have got the QPM now has got one less hike than we had at the previous meeting. These things are not static. Remember that we did something in November, and we did something in this meeting. So these things will keep on changing. The QPM will change from one meeting to the other based on the information that emerges and the data that comes that we will take into account, and the risks to the outlook. So let's not be religious about the QPM. It is just a policy guide that changes from one meeting to the next.
Thank you, Governor. I have no further questions.
Thank you very much, Zianda. That concludes the proceedings of today. Thank you very much for your participation. We will see you in March.